Rest days are important even for the greatest athletes. Sometimes the financial markets have to rest too. The stock market has been on a 3-year winning streak, but with tech stocks slowly moving into bear territory, could that sell-off signal a greater correction in 2022? So today we're going to cover the top 10 things that you need to know about bear markets. Welcome to the channel. My name is Thiago with thefedcorner.com. We're a group of financial planners that are focusing on helping federal employees make better financial decisions. Tech stocks are really great because they can offer you a lot of potential growth, but they can do a lot of damage on the way down as well. Now, if you think about a lot of the indices, such as the S&P 500, for example, and in the TSP, that would be the C fund equivalent, many of those, the top holdings, are considered technology companies. Not all of them are rated as technology in terms of their sector, but they behave like a technology stock would. As such, they have a very big influence on the price of those indices. If the top 10 holdings of an index have started to really pull back, well, you're going to see that because they make such a big portion of that index, the whole index is going to be dragged down as well. So let's start by defining a bear market. A bear market is 20% or more in a reduction in price of a particular stock or of the overall market or index that it's tracking. A 20% reduction can be pretty significant, and is that necessarily a bad thing? Oddly, it's not. A reduction and a pullback, like I mentioned earlier, is a normal part of an economic cycle, and it's actually healthy for the overall economy. But just because it's normal doesn't make it easy to deal with. Everyone has experienced this at some point. You may have opened your TSP balance and noticed that you're down maybe 10 or 15%, or something on TV caught your attention talking about how the markets are starting to reverse. Those are very emotional moments for us as investors. We've worked really hard to save that money and to invest it, and now only to see it slash back. You may be tempted to take some of those CS and I funds that you're invested in and sell them and move them into the G and F funds. And you do this because you're trying to protect your wealth. Those are considered safer funds relative to the CS and I funds. But there's an inherent problem in doing that, especially when the markets have pulled back. And you have to ask yourself, what are these decisions based off of? Are they based from a technical or fundamental analysis of the overall markets? Or are they based on a need that you may have identified of rebalancing or realigning your portfolio to your financial plan? If the answer is no, then this desire to make changes to your portfolio is usually based on one of two things: greed and fear. And the closer you get to retirement, the harder it is to stay the course. We have a graphic that is just one of our favorites and does a really nice job of showing the investor emotion cycle. Let me pull it up here for you. The blue line represents the overall stock market as it rises in value, falls, and then rises again. And each one of these points are emotions that we've seen investors experience throughout the cycle. So as the markets rise, we see investors experience optimism and excitement and exuberance. We hear people talking about how great they feel about their portfolio and the investments they're in. But this is actually approaching the point of maximum risk as we reach the top of the economy. And as we talked about just a few minutes ago, a healthy economy will shortly thereafter have a pullback. And the first thing we see is denial. People start saying, this is just a temporary setback. I'm a long-term investor. I don't need to worry. I can remain focused. But denial begins to turn into fear and desperation and panic as people see their portfolios drop by 10, 15, 20%, maybe more. And this is where we hear people say, you know what, maybe the markets just aren't for me. This is where we see federal employees begin to move their C, S, and I funds into the G and F funds because they're afraid of what is next. They have to stop the bleeding, for lack of a better term. But if you look, as you approach the bottom of the market, this is actually the point of maximum opportunity. However, why would you subject your safe, quote-unquote, investments to this level of risk after just having experienced all of these emotions? That's really difficult because, by the way, this could be over the course of a year, it could be 2 years, it could be 3 years. It could be a very long time of nothing but negative emotions about the market. So how can you possibly put your investments back into risky investments again? But of course, we see the market return back at some point again and continue rising. The danger here is if you're close to retirement and the market is going nothing but down, how is that going to impact your retirement? This could mean that you might have to push your retirement date back. This could mean you don't have as much money saved anymore. And that's the challenge and the fear that a lot of people experience. So we know that there's a bear market coming at some point. Is it this year? Is it next year? It's hard to tell. But fundamentally, you need to understand how to control your emotion, how to work through and invest throughout the cycle like we just discussed. And so here are the most important things that you need to remember during a bear market. The first thing is watch for 20%. Market cycles are measured from peak to trough, and so the minute you see 20% in a reduction, that's when you know you've officially arrived in bear territory. Does that mean it goes right back up again? Not necessarily. It could continue to fall 20, 25, 30, 35, 40 double bears, right? But just know that that's when it's officially a bear market. Number two, historically, stocks lose somewhere around 36% on average inside a bear market. By contrast, a bull market, which is rising, they gain somewhere around 114% on average as we look over the long run. Number three, bear markets are normal. There have been 26 bear markets in the S&P 500 since 1928 and about 27 bull markets in the same time. Number four, if you are properly invested, it's important that you remain invested in that plan that you've developed. As of last December, about 3/4 of the best performing days in the S&P 500 have been during bear markets. And so you can see how if you're getting out of the investments during the downfall, that's actually when you can experience some of the best growth. Number five, on average, you can expect to see a bear market somewhere between 3 and 4 years apart. We've had an extremely long bull market prior to the correction we recently saw last year because of the pandemic, and so that was a little out of scope. But for the most part, 3.6 years is actually the average over the long term. Number six, bear markets are less frequent since World War II and now. So we just talked about 3.6 years on average for a bear market. That's from the 1920s until now. Between the world wars, bear markets were somewhere around 1 to 2 years or so you could expect to see a bear market. Since World War II, now the average is somewhere around 5 years or so. Number seven, bear markets tend to be shorter lived than bull markets. On average, again, over historical data, bear markets have lasted somewhere between 9 and 10 months, where bull markets have lasted somewhere between 2 and 3 years. Number eight, a bear market does not indicate that we're heading into an economic recession. There's been about 26 bear markets, like I said, since the 1920s, but only 15 recessions. Bear markets often go hand in hand with a slowing economy, but there's a lot of different factors that impact the markets that don't have to necessarily do with the economy. Number nine, assuming you'll be an investor for somewhere around 50 years or so, you can expect to experience 14 different bear markets throughout your investor cycle. That can be a lot to deal with and pretty challenging, and each section of your life requires a different strategy to approach it. And finally, while bear markets are really difficult to deal with, most of the time, the markets are actually positive. Over the last 90-something years, only roughly 20 of those years have actually been bear markets. The challenge is if you make the wrong investment choices at the wrong time, it can have a crippling impact on your ability to retire and have financial independence. And simply being diversified does not protect you against that loss. You can be well diversified, but not properly balanced, and also not properly aligned for what your time horizon is, for what your financial plan is, and the goals that you're trying to accomplish. There's tons of data out there that talks about how individual investors underperform the average stock market by several points because they're getting in and out at the wrong times because of the emotions that they're feeling throughout those cycles. There's a study done by Natixis, who is a fund manager, that found that most investors are actually more optimistic about the markets than professional managers. That can be dangerous. If you're feeling too optimistic relative to where the markets are as it relates to your financial plan, you could set yourself up to be in a heap of trouble. Outperforming the markets should not be the goal, but neither should a buy and hold strategy. That really doesn't fit every family's needs. And so you have to have a plan in place that allows you to memorialize what it is that you're accomplishing, that you want to accomplish, and when, and then that becomes the living document from which you're making your investment choices, and it's not acting autonomous to what you're accomplishing in life. And that becomes your investment plan towards a future of dignity and financial independence. It's been said that failing to plan is planning to fail. That sounds like a pretty good New Year's resolution to me, so happy planning in 2022. And if you enjoyed this video, hit the thumbs up. That lets us know that this is the type of content you'd like to see, that you'd like to continue seeing more videos. We're going to throw our website up somewhere on the screen as well, thefedcorner.com, where you can get more information, articles, and learn a little bit more about us as well. We hope to see you next time. We'll be right back.